Greetings children. Welcome to my channel XI Accountancy by Shakun. Today we'll be talking about Chapter 2 Basic Accounting Terms. The contents of this video are trade receivables, trade payables, cost, voucher, discount, bad debts, insolvent, solvent and depreciation. These basic terms are very important because they are the base of accounting, and for a student of accountancy, it is very important to understand the meaning of all these terms. Let's move to the first term, that is trade receivables. Now, trade receivables is the amount which is receivable for the sale of goods or services which are rendered in the ordinary course of business. Stating differently, it is the amount which is due from the customers of an enterprise. So that amount which the firm has to receive from the customers is referred to as trade receivables. Now this amount would be receivable because of the sales which have been made by the enterprise or the services which are rendered by the enterprise. Now trade receivable is the sum total of debtors and bills receivable. Let's understand what debtors and bills receivable are. Now debtor is a person or it is an entity or an enterprise who owes amount to the enterprise, to the business unit against the credit sale of goods or the services rendered. So if the business has made sales to a person, let's say for example, goods sold to Raman on credit. So the firm or the business has sold goods to Raman. Now Raman is a debtor for the business because Raman has to pay an amount to the firm. He owes an amount to the firm on account of sales made to him. So the person who has to pay money to the business is termed as a debtor. Bills receivable. It means a bills of exchange accepted by a debtor, the amount of which will be received on a specified date. Now in the same example, goods sold to Raman. If Raman accepts a bill and he agrees to make a payment after a period of let's say 3 months. Now if he says that verbally we can't agree to it, so we need to have a documentary evidence. So a document called bills of exchange is prepared on which is signed by both the business as well as the debtor, stating that the money will be paid at a later date. So that is referred to as a bill of exchange, the bill against which the firm has to receive a payment. So the total of debtors and bills receivable is known as trade receivable. Moving on to the next term, we have trade payables. Trade payable is the amount which is payable for the purchase of goods or services which are taken in the ordinary course of business. Stating differently, it is the amount due to the seller of the goods by the enterprise. It is the amount which the enterprise has to pay to the seller of the goods. Trade payables is equal to the sum of creditors and bills payable. We need to understand what are creditors and bills payable. Creditor basically is a person or it can be an enterprise to whom an enterprise owes amount against the credit purchases of goods or the services that are taken. For example, if goods are purchased from ABC company, that means goods have been purchased by the business but the amount has not been paid to ABC and company. So since the business is required to make a payment to ABC and Company. ABC and Company is the creditor for the business, a person to whom the payment has to be made on account of the credit purchases. Now, bills payable, it means a bill of exchange which is accepted by the person or enterprise, the amount of which will be payable on the specified date. Now, similarly, if we accept, like in the previous case, I told you that the debtor accepts. Here, the bill of exchange may be made by the seller and it may be accepted by the business, stating that the money will be paid after a specified period of time. So that documentary evidence is called as bills of exchange. So bills payable basically is the bill of exchange which shows that the business will make the payment after a specified period of time. So the total of creditor and the bills payables amounts to trade payables. The next term is cost. Cost is the amount of expenditure which is incurred on products, articles, or activity. So cost of manufacturing a product, cost of purchasing an article, or cost of carrying out an activity. All these are included in cost. A business firm should always try to reduce the cost in order to increase the amount of profits that the firms make. Moving on to the next term, we have vouchers. Voucher is an evidence of a business transaction. It is also known as source documents. These can be provided as evidence in the court of law, and the examples can be cash memo or invoices or bills, debit notes, credit notes, etc. Now, all these vouchers are the basis on which the transactions are recorded in the books of accounts. So, they are the evidence of business transactions. They are a proof that the business transactions happened, and on the basis of these vouchers, they are recorded in the books of accounts. Moving on to the next term, we have discount. Discount is the reduction in the price of the goods or from the amount to be paid to a customer by the enterprise. Discount allowed may be trade discount or cash discount. Trade discount is the discount which is allowed on the bulk purchases or sales. It is the reduction in the price or in the amount that is to be paid by the customer whenever bulk purchases or sales are made, then the trade discount may be allowed. It is subtracted from the purchases or sales value, and the net sales or net purchases are shown in the books of accounts. Cash discount is allowed when timely payment is made by the customer. So when the customer makes timely payment, then cash discount is allowed. It is an expense for the party who is allowing the cash discount, and it is income for the party who is receiving the cash discount. So discount, which is a very common term, means decrease or lesser price which you have to pay by the customer to the enterprise, and it is of two types, trade discount and cash discount. Please always remember, trade discount is always on the bulk purchases. If a person is making bulk purchases, means let's say 20,000 tons of wheat. So when the bulk purchases are made, then the trade discount is allowed. And cash discount is allowed when the cash payment is made. So if let's say the company has a policy that a person who makes a payment within 14 days will be allowed a discount of 10%. So in such a situation, cash discount may be allowed. Moving on to the next term, we have bad debts. Bad debt is the amount which is owed to the business that is written off because it has become irrecoverable. Now it is a loss for the business and it is thus debited to profit and loss account. If you can see from the picture, you can see John owes XBBR Inc. $500. And XBBR Inc., the credit manager, is thinking that 6 months overdue but not a sign of John. So that means that whenever a person has to pay some amount of money to the business and that money is irrecoverable from that person, then we call it as bad debts. For example, if a person is unable to pay his debts, he becomes insolvent. Let's say he had to pay 1,000 rupees to the firm. Out of that, he was only able to pay 400 rupees to the firm. Now, the 600 rupees which he was not able to pay to the firm is not a discount that we are offering. It is known as bad debts because our debts have become bad and we will not be able to recover or receive this amount from the person. So, bad debts is the amount which is not recoverable from a particular person and it is written off as a loss and debited to P&L account. Moving on to the next terms, insolvent and solvent. Insolvent is a person or an enterprise which is not in a position to pay off its debts. So those companies or those people who are unable to pay the amount which is owed to the third parties, they are called as insolvent. Whereas solvent is a person who is in a position or an enterprise which is in a position to pay off its debts. So solvent means can pay the debts. Insolvent means cannot pay the debts. The next term is depreciation. Depreciation is a decline or a decrease or a fall in the value of an asset because of usage over the years, because of the passage of time which has passed. It may be also because of obsolescence. Obsolescence means that there is a change in technology because of which our asset has become useless. So there can be fall in the value of an asset because it has been used over the years, or because some time period has passed, or because the asset has become out of date, out of technology, or there was some accident because of which the asset has become useless. So basically, depreciation is the decrease in the value of an asset over its useful life. So these are usage, efflux of time, obsolescence, accident. All these are the reasons why depreciation is charged. Also, if you take it in your personal life, you all must be having some cars at your house. So these cars, let's say you purchased a car at rupees, let's say 7 lakh. Now, after 5 years, if you want to sell the car, will you be able to sell it for rupees 7 lakhs? No. Let's say you were able to sell it for rupees 4.5 lakh. Now, the decline in the value of the amount of the car, you had purchased it for 7 lakh, but you are able to sell it after 5 years at 4.5 lakh. Now, the decline in the value, or the fall in the value, is because of usage, because of passage of time, because of wear and tear that the car has suffered. So because of all these reasons, because of depreciation, there is lesser value which you will receive when you try to sell it. So in this video, we have talked about trade receivables and trade payables. Trade receivables are debtors plus bills receivable, whereas trade payables are creditors plus bills payable. We talked about the cost, which is relating to the cost of articles or the products or the activities. We talked about vouchers, which are the documentary evidences. We talked about discount, that is the reduction in the prices, and it's of two types, trade discount and cash discount. We also talked about the bad debts, the irrecoverable amounts. We talked about insolvent and solvent. The insolvent is a person who is unable to pay his debts, and solvent is a person who is able to pay his debts. We also talked about depreciation, which is the decline in the value of an asset because of wear and tear. I hope all these concepts were clear to you. If you liked my content, please like my video, subscribe to my channel Inside Accountancy by Shakun, and please hit the bell button. You will be notified as soon as I put a new video. Please keep on showing your love and support. It really motivates me to upload more content. Thank you so much for your cooperation.